In this video, we're going to complete the Argus model we've been working on and provide a full cash flow projection. The final step will focus on future market projections for the leasable space at the property. So far, we spent time entering the contractual revenue and the projected expenses based on historical financials. Now we'll move on to making assumptions about the market, specifically for the leasable industrial space at this location. The main objective here is to define some key market assumptions. This video will take us through the completion of our Argus file and our pro forma cash flow statement, and will allow us to generate a complete cash flow projection that can be exported into Excel for further analysis. Let's dive in by reviewing the seller provided rent roll. Our focus now is on creating market leasing assumptions, which will affect the current vacancy at the property, as well as define a market rent for the leased spaces at the property when the existing leases expire. So to start with the existing vacancy, we'll begin by projecting when we can lease the vacant suite and the key terms for that lease, like the lease duration and the base rental rate. So first, let's look at this vacant suite 500. We can see this is the smallest space at the property at 4,000 square feet. The other spaces range up to 30,000 feet at the largest. So we'll need to estimate when we think this space will be leased and for how long. Suppose we're purchasing the property in January of 2025. So we'll assume it takes around 9 months for the space to lease up. So we'll set the lease start date to September 2025 with a 5-year lease term. And a quick trick in Excel to calculate a lease expiration date is using the EO month formula. This will allow us to take a start date in another cell and add some amount of months to it and get the ending date. Now let's see, for the base rent, we'll assume $14.50 per square foot, which actually matches the current average rent for all the other spaces that are leased right now at the property. And additionally, we'll assume a 3% annual rent increase, which is pretty common for industrial properties. These escalations are going to be put into Argus as a percentage increase over the lease term. So we're just going to use the 3% in Excel right now. So let's input this data into Argus by creating a market leasing profile. And we'll name this profile $14.50 triple net. That clearly describes what the base is and what the lease structure is. So it's really easy for us to identify exactly what this market leasing profile is. So next, let's set the renewal probability to 75%. And what this does, this figure helps Argus calculate leasing costs associated with renewing a tenant or finding a new one. If a tenant doesn't renew, it usually takes time to find a new tenant, so we'll assume 9 months of vacancy in between leases. Now we'll set the market base rent per square foot on this space to the $14.50 that we were showing in our Excel file, and we'll set the lease escalations to the 3% that we outlined in our Excel file. We'll scroll over to fixed steps and select percentage increase from the dialog box, and there we go, we can set it to 3%. Now if we scroll over to recoveries, this is where we can set the expense reimbursement profile for the leasing assumption. At this property specifically, we know that all the other tenants are on a triple net structure, so we'll go ahead and assume that any new leases with this market leasing profile will be the same, and we'll go ahead and set that to net. For tenant improvements or TIs, we'll assume $10 a square foot for new tenants and $5 a square foot for renewals. And leasing commissions, these are typically a percentage of the total lease income. We will set these to 6% for new leases and 4% for renewals. Now, the one common leasing cost that we left off, but it's worth noting, is free rent. Free rent is just input as a number of months into Argus. And this is also calculated using the probability weighting. So we'll usually set a certain assumption for new leases and a certain assumption for renewals, just like we did with all the other leasing costs. And Argus will calculate that based on the probability. We now have all the leasing assumptions in place, and we'll assign this leasing profile to the vacant space, and we'll actually assign it to all the other tenants on our rent roll tab and just use this one market leasing profile. So to do that, we'll scroll all the way over to the right to the market leasing section, open the dialog box, and select the market leasing profile we would like to assign. In a lot of cases, we may want to use multiple market leasing assumptions with the same property. So it's helpful to name these market leasing profiles something that's easy to understand, easy to identify, because you will be searching for those profiles within this rent roll tab. So now that we have our market leasing profile assigned, we need to set the lease variables for the vacant space to market so that Argus knows to apply our MLA assumptions at the time that the space leases. So all these lease variables that we're setting to market could also be manually entered if for whatever reason we had specific assumptions we wanted to make for the vacant space to be leased. But since we don't have any other specific information here, we'll just go ahead and use the market assumption. Now that we've done that, let's revisit inflation. Just like we inflated the expenses in the last video, we'll apply a 3% inflation rate to revenue as well. And this means that $14.50 a square foot of base rent, that will also increase by 3% annually. Now, if we look at the cash flow projections, we can see that revenue stabilizes as leases are renewed and new tenants come into the property. This inflation adjustment gives us a smoother NOI over time, which averages to about 900,000 to $1 million annually once the property is stabilized. And we can see that it continues to grow as existing spaces are released using our market assumption. In year 7, NOI has reached all the way up to 1.2 million. So before we wrap up, let's add one more thing. Let's add a capital reserve expense. Now this is a small reserve, typically under $1 per square foot, that accounts for unplanned repairs or improvements and just helps our underwriting be a little bit more conservative. For this example, we'll assume 10 cents a square foot for this property. And now let's generate the cash flow report and let's export it to Excel. So in Excel, it's a lot easier to manipulate the data for further analysis or to add other modeling components such as a partnership waterfall. We can add debt. We can use a sales price based on an exit cap rate and make adjustments to that a lot more quickly if we're doing it in Excel. So this is pretty typical for the way that most private equity or brokerage firms will use Argus cash flows. So now that's it, and we've completed our basic Argus pro forma with all of our necessary assumptions, projected revenue, expenses, and we have our cash flow statement. So in the next video, we'll take these projections and we'll actually run some quick exercises in Excel to show how most private equity firms would typically use Argus cash flows for investment decisions. So thanks for watching. If you found this helpful, don't forget to like and subscribe for more insights into commercial real estate private equity.